Hello, and welcome to today's webinar. Why does everything cost so much? A strategic assessment of the current business and economic environment. This webinar is brought to you by Court Magazine in partnership with the Best and Brightest Programs and NABR. Today's sponsor is Blackford Capital. My name is Gina Bryant, Program Experience Administrator with Court Magazine. Before we get started, I just have a quick announcement to make. With this platform, you will be off camera and on mute during the presentation, but we do want to hear from you. Please use the questions box you see in the right-hand portion of your screen to submit any questions or comments during this broadcast. Our moderator today is Martin Stein, founder and managing director of Blackford Capital, a leading lower middle market private equity firm with a focus on manufacturing, industrial, and distribution industries. I'd like to now go ahead and give it over to Martin. Martin, go ahead, you have the floor.
Thank you so much, Gina. It's a pleasure to be here. And thank you to all of our attendees for joining us. As Gina said, my name is Martin Stein. I'm the founder and managing director of Blackford Capital. Blackford Capital is a lower middle market private equity firm, and we focus on acquisitions of family and founder-owned businesses across North America. Blackford specializes in companies that make things, so industrial businesses, distributors, and consumer products goods companies. This is our third webinar in our series, What's Going On in the World of Business, where we try and tackle some of the largest issues facing business today. Our first webinar was What the Hell is Wrong with the Supply Chain, followed by Where Did All the Workers Go? And this webinar is now Why Does Everything Cost So Much? I'm joined by three great panelists here who have a wealth of experience and a lot of understanding of this topic area. We have with us Michelle Krebs. Michelle is the Director of Automotive Relations for Auto Trader Group and has been an analyst at Cox Automotive for the last 10 years. And we appreciate her being here. Scott Brave is the Head of Economic Analytics at Morning Consult. And had worked with the Federal Reserve Bank of Chicago for 20 years. And we have Dr. Ricky Volpe, who is an associate professor at the agribusiness department at California Polytechnic University. So thank you very much to all of our panelists for being here. Before we get into some of the comments from the panelists, we are going to set the stage and talk a little bit about the topic area of inflation and why is it important? What can be done about it, and what are some of the thoughts for the factors that have given rise to our current inflationary environment. So I'm going to go through some slides, and then we will turn it over to our panelists to have some conversations on this topic area. Okay, why does everything cost so much? Well, first, we're going to start off with what is inflation exactly? And we've got a textbook definition here that I'm going to read. A general increase in the prices of goods and services in an economy. When the general price level rises, each unit of currency buys fewer goods and services. Consequently, inflation corresponds to a reduction in the purchasing power of money. What that means in layman terms is a dollar simply can't buy what it used to. In other words, we have the same product or good, and you have to spend more money buying that exact product. So, how significant is the current crisis that we're facing? Well, if you look at the last 80 years, inflationary environments have occurred 6 times previously, and we are in our 7th episode right now. What's fascinating as you think about this is, as this chart shows, each of these episodes of high inflation are literally happening at the same time at very significant historic events. So we had World War II, and after that concluded, there was a very high inflationary environment. It makes sense. We had the Korean War. There were the 1970s oil shocks that produced some very high inflation. And now we have the post-COVID world, as well as a war that's occurring in Ukraine. So this is not the highest period of inflation that we've had, but it is the highest that we've had in some time. It's also not the lowest. So historically, in the last 80 years, the last 3 or 4 generations, we're in a pretty significant era right now. This is happening all over the world. It's not just in the United States. And as you look at this chart, you can see Lithuania, Estonia, Latvia, the Czech Republic, Poland. Those are all the countries that are having the most significant levels of inflation. Those are obviously all of the countries around and bordering the war in Ukraine. So clearly there are a lot of dynamics that are affecting that region. The United States and Mexico shows up in about the middle of all of the countries listed. And so generally speaking, we're not the least inflationary economy, nor are we the most. Down at the bottom of the pack, you see China and Japan, Saudi Arabia. Those countries have some established monetary policy and, at least in China's case, deliberately looking to lower the value of the renminbi, and that is reducing their inflation rates. Well, the impact at home is very significant. This chart shows the purchasing power index at the wholesale level. So these are the prices that the manufacturers and providers are experiencing. This is not all the way to the end user. So there could be steps in the value chain, but this shows what has happened over the course of the last year. And as you can see, energy is literally up almost 40%, transportation and housing above 20%, general trade and goods also around 20%, food. And food is something that obviously, whether it's an inflationary environment or not, you have to eat, is also quite high. The impact of this is that about 40% of holiday shoppers say that this is changing the way they shop, and almost 60% plan to buy fewer items. That'll definitely have an impact here as we go into the holiday season and one of the most important times for retailers. Not only is there an impact at home, there's an impact on homes. This chart shows the last 50 years and the historic 30-year mortgage rates. And what you can see here is, while the average has generally been higher than where we are right now, we are also at the highest point in the last 20 years. Not since back at the turn of the millennium were mortgage prices at this level. So this will definitely affect home buying. It's also having a pretty significant impact on business. These 5 areas or categories show some of the amounts and level of increases that have occurred over the course of the last 12 months. Again, you're seeing similar categories here, but energy very high, rent very high, logistics and warehousing. COGS, of course, will vary quite a bit. But the interesting one that we're going to spend another minute talking about is wages. I'm sure everyone is familiar with the effort to move to the $15 per hour as the minimum wage that has occurred in a number of different geographies. Well, despite that increase in amount, wages are actually declining for most American workers. And 71% of American employees now say the cost of living is outpacing the growth in their pay. So whereas a year ago we saw a dramatic increase in pay, now what we're seeing is a pretty significant decline in what that increased pay will actually allow you to buy. And the weekly earnings have fallen another 3.7% in October from a year earlier. So all of these are very significant and does have an impact on what consumers are going to be able to spend their money on and buy. One of the measures that the government has to combat inflation is by increasing the federal funds rate. And what we have here is the last 70 years for the federal funds rate. And we can see again, back in certain periods of time, the 70s with the oil shocks, in the 1980s, the federal funds rate were considerably higher than we are now. With that said, the rate has been declining for the most part over the course of the last 40 years. And in the last 10 years, it's basically been nothing. We had an increase that occurred before COVID and then went down again to nothing during COVID. And now we've had a pretty rapid increase that has occurred in over the course of this past year. We are not the only country to be doing this. You are seeing this across the world. This chart shows the rise in central bank lending rates in 2022 by percentage points. And you can essentially see that in a large number of countries, they are choosing to use similar activities to reduce the problem of inflation. Well, this is what we're going to be spending the bulk of our time talking about, is what is it that you can do about this? And we want to evidence a old school thinking versus the new school thinking. The old school way that businesses would handle inflation is that first they would adjust their prices. Second, they might scale back and sort of reduce their ambitions to accept smaller margins and reduce the input as the relative prices change. And then they would also prioritize high profit margins. And that has been the way of handling inflationary environments from a business perspective for an extended period of time. Given what has transpired in COVID and looking at the new economy, we have some new ideas that have come up. We'll eventually get to our panelists and we'll ask them their thoughts on this. But what many businesses are looking to do now is to streamline their value streams and get automation so that they're not as dependent upon workers, do a much more sophisticated analysis on the profit margins and use artificial intelligence to know exactly where they're making money, do that on an activity-based accounting methodology. They're trying to find ways to share the benefits and incent productivity with employees, absolutely looking at cutting expenses when and where possible, raising prices, but doing it more judiciously so that they're thoughtful, because there's an effort to make sure that you're pursuing the right customers. And then also be ready for a new customer segment, because it is true that when you come into an inflationary environment and we are looking at going into a time of a recession, that some of the customers won't survive. And so a lot of companies are going for market share. So that sets the table for us and allows us to understand the dynamics of what's going on. Let's turn it over to our panelists here and get their input and their impressions on what it is that is occurring within our economy today. Scott, I'd love to get your reaction to some of the slides and some of the data that we just shared. What is it that you think is the cause behind our current inflationary environment?
Yeah, it's a really hard question to answer, but I think it's very clear at this point there are both supply and demand elements to what we're seeing with inflation. COVID was certainly the precursor to a lot of this. We came into this environment with low and stable inflation. The Fed sort of was actually a little worried that inflation might be a little too low. Came up with a new framework to try to make sure that we kind of got back to that 2% average inflation target. COVID came along, revealed a lot of issues on the supply side of the economy, which we really shouldn't be too surprised about, given that we kind of shut everything down and then tried to start it back up again. And then there is also the demand side. At the same time that the supply side of the economy was struggling to recover and get back up to speed, demand was also stimulated, and in some places probably a little bit too much. So demand outpacing supply, that's a recipe for inflation.
Very interesting. Ricky, do you agree with what Scott had to say?
Oh, absolutely. My perspective on what's going on with inflation right now is obviously focused mostly on the food supply chain, agribusiness. That's kind of, my area. It's what I think a lot about. It's what I research. And I think Scott was right in terms of the macroeconomic impacts. And he said something that I absolutely want to echo, which is that COVID was a major event. In many ways, it was a game changer. In many ways, we're still feeling the effects of COVID. But in my personal opinion, the most important thing that COVID did, at least for the food supply chain, and by the way, now I want to go back and check out your last webinar on what's wrong with the supply chain. But I think that it was really effective in shining a light on these sort of structural, long-term, persistent issues that were affecting the agribusiness sector, the food systems, that became really obvious during COVID. And I'm talking about issues like transportation bottlenecks, labor shortages, having absolutely no sort of reserve or slack supply of labor, and all of the different issues that come with having a food supply chain that over the last 30, 40, 50 years has become very, very consolidated. And then it's led to a rigidity in the supply chain that COVID really, really focused on and made apparent.
It's interesting, you mentioned rigidity, and one of the things that we hear about a lot now is flexibility. Michelle, you've done a lot of work with the automotive manufacturers, and flexibility is something that they've really had to think about and become more active. I guess still thinking through some of the causes for our inflationary environment. Do you agree with Ricky that it was the result of a sort of rigid supply chain and then the onset of COVID, or were there other factors that contributed towards it?
Well, I think that the very first thing was the onset of COVID. Everything shut down, as both of you have said, across the globe. and everybody braced for a recession. Didn't happen, lasted for a couple days. And in fact, demand for vehicles was skyrocketed because people didn't want to use public transportation. They didn't want to use ride hailing. We heard stories of people buying cars that had never bought them before. So the demand was huge. And at the same time, as Ricky talked about the supply chain, it uncovered some significant deficits, mostly being the chip shortage, but there were labor shortages and other parts shortages. The chip shortage hit everybody. And so it's uncovered that, and now automakers are looking for different kinds of solutions to that. They don't want that to happen again.
You've all mentioned COVID, and of course we can't ignore that or pretend that it didn't happen. It certainly had an enormous impact as we shut everything down, but COVID is over, right? I mean, that was 2 years ago, and here we are dealing with the inflationary environment. So it seems a long way to go back at this point in time. I guess the question is, now starting to look forward, is how much longer is this going to continue? COVID is done, that was the cause for it, and yet here we are facing the inflation 2 years later.
I would argue it's not really over. I mean, if you look at what's happening in China and Southeast Asia, which is where we get chips and where we get lots of components, it's not over. And of course, there's the shipping aspect of it and logistics that go along with that. So I don't think it's over, at least for the industry.
I'm going to echo that. And on the labor side in particular, still, there are a lot of studies coming out now showing that long COVID effects are still having impacts on labor supply. You know, labor supply has not bounced back. A lot of people left the labor force, or a lot of early retirements. Thought would be maybe those people might come back. I think COVID changed the way people look at the way work is done and where work is done. This push to have hybrid working and work from home. There are a lot of sort of these structural impacts that, while it's not precipitated directly by COVID, the indirect effects are still there, and they're going to be felt for some time.
Yeah, I absolutely agree. Sorry, Mark.
Yeah, I want to get to you. So I said 2 parts. You know, one was COVID is done. How long is this going to last? Michelle and Scott, you both said, no, COVID is not done. We're still having issues with COVID. I guess, Ricky, to you. So how long is this going to last then? COVID, according to Scott and Michelle, we still are feeling the effects. You know, you focused a lot on food supply. There's probably nothing more important in the economy that people get. How much longer can we expect this inflation to be in front of us?
Yeah, I think, you know, both my fellow panelists have touched on the labor impact, and that's the issue where for the food supply chain, when we talk food manufacturing, grocery, I can't give you a timeline on that, but I can tell you that is an example of an impact of COVID that's going to extend for the foreseeable future. You know, COVID hit, and a lot of us were forced into our homes. A lot of us have, you know, like Scott said, have adopted these hybrid schedules, this sort of flexibility in terms of location and workplace, and that really doesn't apply to most jobs in food, you know, from production to manufacturing to retail, all of that. And those jobs, especially during the pandemic, became more dangerous, more stressful, more demanding. A lot of those are minimum wage, low paying jobs, and the demand for those jobs has really gone down. And it's to the point where it is difficult to come across, especially an independent supermarket that is fully staffed. It is extremely common to talk to a supermarket manager who spends at least a part of his or her day wiping up spills, because there's simply nobody else to do it. And that's, of course, not an efficient and effective use of a store manager's time. Just to flip to the consumer side real quick, if we can talk about what may be a spot of good news. I do think that food retailers have largely adapted to how consumer behavior has changed as a result of COVID. And part of that has translated into an increased demand in some of these more ready to eat, higher margin foods. And I think that's been sort of a net positive for everybody. They're higher margin, higher profitability for supermarkets. Consumers have a strong demand for them. They make food shopping fun. They take the guesswork out of meals. They appeal to people who weren't really grocery shopping much before the pandemic. So on the demand side, I do think we're starting to reach equilibrium. I think for the most part, panic buying and consumer stockpiling is behind us. It's just that consumer demands have evolved somewhat as a result of the pandemic.
Martin, I wanted to mention a couple pieces of news in the auto industry that illustrate the labor shortage. Just this past week, Mazda, which built a brand new car plant in Alabama with Toyota and launched a brand new vehicle, said they don't have enough people to add a second shift. So it's really slowing the launch of their brand new vehicle that they were counting on. The week before, Subaru, which has a big plant in Indiana, said they have a labor shortage. They can't match the wages that the local McDonald's is paying. So it's widespread, and I think it's going to be a big issue going forward. We've got labor talks next year with the United Auto Workers Union, the Canadian Auto Workers Union, and I think it'll be a hot topic.
Well, this is interesting. I still we're holding open how long will it last, and maybe we'll come back to that. I know it's a no one knows the exact answer, but we've talked about structural things. And I guess what I hear on that as we think through the projection, Michelle, Ricky, you both mentioned that we've got this dynamic that's occurring, which we talked a lot about in our last webinar. Where did all the workers go? Where, as I mentioned in the slides, workers got paid more, but it can buy less. And so now they're choosing not to be involved in it. It seems, Scott said this is a basic supply demand issue that we have here. Well, there are still workers there. We haven't lost 50% of them. We've lost, 5 to 8% or so of the workers that are no longer in the workforce. But will this just continue, that workers aren't getting paid enough, so we pay them more, so that increases prices? And I mean, that's the very heart of inflation. And while it's good, you also don't want to have too much. So I guess still going back to the dynamic that we have here, it sounds what you're saying that this could go on for quite a while.
Certainly the reshuffling that we're seeing in the labor market and consumers' consumption bundles, yeah, I don't think that's going away. I don't think that's over. In fact, if you look at sort of the consumption bundle pre-pandemic to what it looks like now, consumers are still spending a lot more on goods than they were, prior to the pandemic. There's been this expectation that the economy would open back up, consumers would go back to those pre-pandemic spending patterns, buying more services again, and we just haven't seen that. There's been some elements of that, certainly over the summer, travel, vacations, that picked up a lot. I mean, we saw a big spike there. People wanted to get out and about, but consumption patterns have changed. And on the same side, labor patterns have changed. There are some industries, even though we've recovered a lot of jobs, there are some industries that are not back to where they were pre-pandemic. Leisure and hospitality is a big one there. There's some areas where workers have decided they don't want to work there anymore. The preferences have changed. So, those are more structural things, and they take a while to work out. And certainly, yeah, you're going to see wages reflect that, right? Because wages then have to arise to attract the labor to those areas. But those are mostly relative price changes. I think I want to emphasize, inflation is everything going up at the same time. It's more of a macro phenomenon, and that's where the demand element here is very important. We've talked a lot about supply. I do feel like supply is healing and we're on the right path there, but the demand element, we haven't really seen that pull back yet. Maybe some signs of it, but not yet. And so as long as demand continues to outpace supply, inflation is going to remain an issue.
Rick, you look like you had something to say there, and before you jump in, I want to thank. We're starting to get some great questions in here, and we'll get to those in a minute. But please, all of the attendees should feel free to put their questions in the question section, and we will go through them as they come up and as they're relevant. But thank you very much for your participation. Ricky, did you have a response to Scott's comment?
Well, it's more just sort of adding on and also addressing something that you actually said, Martin, because it's a really good point and it sort of bears fleshing out. You said wages are going up, but the question is how much are they able to buy? And that's the very nature of inflation. And I live in California. California, I think, is tied for the highest mandated minimum wage in the United States. And if you control for the value of the US dollar, if you control for inflation, the minimum wage in California has gone up by 1% since 1968. Now, spending categories like
1% since 1968.
Just over 1%. If you account for the value of the US dollar. So the minimum wage in California is effectively flat in the long run. However, Other major spending categories, especially spending categories that are really, really important for our sort of lower income minimum wage demographic, rent, utilities, medical care, those are all up double, if not triple figures over that same period of time. So first of all, as a point in terms of how inflation can really matter depending on which spending category you're looking at, that's sort of a lesson in that. But also, second of all, why is this a problem with respect to continued inflation? People, workers, even young workers, even our high school workers, so on and so forth, they look at these jobs and they see what $15 an hour is going to get them in terms of cost of living and spending power and all of that, and they just choose not to. And that's a problem for continued inflation in food prices, whether we're talking about retail or manufacturing or harvesting or whatever, because this is going to lead to labor shortages and higher turnover, both of which are very costly for food companies. Both of these continue to impact inflation and drive up food prices. I don't really see any solutions to this in the short run. I personally don't see this moving in the right direction anytime soon.
Well, so you're a good pessimistic outcome here, Ricky, that we're in a tough time and it's not going to get any easier anytime soon.
Martin, could I add too, we haven't mentioned this in our conversations, but interest rates. I mean, inflation's not affecting everyone the same. And we really see that bear out in the auto industry. There are people, because of interest rates, and which lead to higher car loan rates, they cannot afford a new car. They can't afford maybe even a used car because the interest rates on top of the high vehicle prices hit them more. I mean, the subprime aspect of borrowing for car loans has dropped significantly. So really, the new car market is a rich person's game anymore. And we're seeing more people pay cash than we ever have. So it's a huge difference in the impact.
Wow.
I can echo that as well. We see that in our high frequency data.
Right.
Morning consult, we track the inflation response very closely across different income demographics, generations, and things like that. Certainly the old adage that low income individuals are sort of always at the vanguard of the response to inflation, that was right there. They were right there, got hit right away in the spring. It started to spill over into the middle income consumers over the summer. We actually did see the high income consumers pull back a little bit in the early fall. Though our latest data we just put out this morning, a memo on, we see some improvements there. So, the demand destruction side of this is really important. That's what the Fed is focused on, slowing demand to bring it back closer into alignment with supply. And that's what we're still waiting to see. The consumer's been really resilient. They've have a big buffer of savings that they built up during the pandemic. For the lower and middle income people, that's largely gone now. And so we'll see here over the next 3 months or so, 6 months, where we're headed. How far will demand need to pull back to bring inflation down, and how quickly will inflation come back?
I'm wondering, we've talked a lot about some of these structural issues that are going on here, and you all seem aligned that the inflationary environment is here to stay for a while. Are we going to get to a dynamic? This is one of the questions from our audience members. Have entry-level wages risen too high so that businesses are not going to be able to sustain and maintain their profits? And by that, I think, is it going to be more challenging for businesses to be hiring new younger workers because they're just not getting the return on the investment in that level of the labor market?
I guess I would say that's the natural economic adjustment process. That's what you'd want to see. If there is a shortage, wages should rise. It should start to eat into profits, and you'll see an adjustment there on the supply side eventually. I think those are the kinds of things you're going to have to see if you want inflation to come down. There is an element of pain to pulling back the inflation rate. I think it's unavoidable. So that would be my perspective on that.
Will inflation lead to another one of the questions from our audience members, very timely and relevant for what we're talking about. But based on this, right? I mean, the workforce is going to get to a spot where they have to earn more money, right? You can't choose to be out of the workforce. Is it possible that inflation could result in the workforce returning back to the pre-COVID levels because people are forced back to work? Scott, you're shaking your head. Yes, you think so?
There is an element of that on the margin, sure. I think we have to remember who left the labor force during COVID, and those individuals might not be the ones that are the most sensitive to that, right? They tend to be older workers, wealth assets there, big declines in the stock market or something like that might, be more likely to bring them back into the labor force. And I think when we're talking about wages here, it is very much on a different margin. In certain industries, yeah, I think that's the way you're going to see those industries kind of get back on track. But broad labor force trends, I just don't see that.
Moving on from the projections and how long this is going to, is going to take, it does seem that there are some areas that the prices are up considerably. It also seems like there may be some areas where things aren't costing, quite as much. Are you seeing that it's affecting the economy differently than past inflationary environments have? Scott?
Yeah, I think what I'm really focused on with this inflationary environment, it's different. There are things that are similar to the 70s and 80s, but at the same time, it is very different. There were oil price shocks back then. This was more of sort of a labor shock with COVID. The way we've kind of tried to analyze this is we have some high frequency data that measures something called our purchasing power barometer, where we look at individual sectors of the economy and we kind of try to get a sense of what consumers are doing in those sectors in response to inflation. So if they see a surprise, a higher price than what they expected, do they walk away? We call that sticker shock. Or do they trade down to a cheaper substitute? Kind of those classic responses that you would think. And what we've noticed throughout most of this period is those kinds of behaviors have been shared across categories. Most categories are looking that way. There are some exceptions though. Home improvement goods were one that kind of shrugged things off. People, and that's not surprising if you think people were stuck in their homes for a long time and decided to, upgrade their home, invest in their home. And so there's been some less reluctance to push back in prices, price increases in an area like that. But in general, we've seen this building within the consumer sector where they are starting to get fed up with the price increases. And we saw some big pullbacks in August and September, big sticker shock and trading down. Now, what I can report is the memo that we just put out this morning suggests in October that turned a little bit. And I think if we start digging deeper into that, and we think about what happened with the CPI last week, we're starting to see a little bit of inflation relief, particularly on the goods side of things now. So the consumers are kind of taking advantage of that at the moment. The services side, however, it was already mentioned, rents, things of that nature, they're still very much a top of mind concern for consumers.
What's happened in the auto industry, though, is you may want to trade down, but you won't be able to, because what the automakers have done is they are using those chips and the parts that they have and allocating them to their highest demand, highest priced, highest profit margin vehicles. I track inventory, it's really hard to get a compact car. It's hard to get a small sport utility that's costs under $30,000. So even though you may want to trade down, you may not be able to. Now, Ford mentioned a week or so ago that they are seeing people kind of edge down from their big fancy trucks to less fancy trucks. And we have seen some movement in the truck market down to smaller trucks. But by and large, it's big vehicles, expensive vehicles that are selling because that's the audience that can afford them.
Everybody with food, everyone's got to eat, right? So we don't tend to see much of a change in aggregate food spending, kind of regardless of what's going on in the economy. There's some variation and there's some substitution between at home and away from home. But it is interesting to see right now in brick and mortar food retailing, who are the retailers that are absolutely on fire? It's, Aldi. Aldi's on track to have, 3,000 stores in the US by the end of 2024. Grocery Outlet just put out an ambitious plan to have 5,000 stores across the United States and undertake a national expansion. Walmart, when it comes to food and grocery, everybody talks about Amazon because they're sort of the new, big one, right? And they're in the cloud. You can't see them and they can compete against anybody. But I mean, Walmart's dominance, I don't think is going away anytime soon in food or really in most areas of consumer spending. I mean, Walmart's investing billions in these MFCs, these market fulfillment centers that are appended right to their super centers that help them to blend on the channel into sort of this one powerful digital framework to increase sales and improve their inventory management, both in store and online for perishables and durables. It's a fascinating time, but from my perspective, almost all of the growth in the industry is happening in the hard discounting value sector, and I don't really see that changing anytime soon.
Wow. So we're talking about food here, Ricky, and the impact that you're seeing, and that is very interesting commentary that you've got. One of the audience members asked about the impact of war on those prices. How much is of the current war is affecting it versus how much is COVID?
In my view right now, I don't know of anybody who's actually gone through the effort of trying to disentangle the lingering impacts of COVID from what's going on in the war in the Ukraine. But it seems to me pretty clear that the ongoing conflict is probably a larger factor in shaping food prices than anything COVID related, even if you even if you were to attribute these ongoing sort of grocery and manufacturing labor shortages to COVID, which I think at this point is kind of a stretch, at least in food. The war in Ukraine is having pretty acute, noticeable effects. I mean, it's probably the most important reason why we've seen the prices for bread and grain-based products and cereal-based products go up quite a bit throughout 2022. It's been a major factor for driving up the price of anything that's based on vegetable oils, sunflower oils, seed oils, that sort of thing. And it's also been very important for driving up the price of fertilizer and a few other hard commodities that are used in the United States as sort of these sort of fundamental inputs to the food supply chain. And the tough news on that, and it's one of the reasons why I'm not really optimistic for anything approaching normal food price inflation in 2023, is because a lot of these factors, if the war in Ukraine jacks up or is responsible for a significant jump in fertilizer prices, for example, we're not going to see that in the supermarket shelves for months and months, well into the early part of 2023. Then that's just the nature of price transmission via these agricultural commodities. So I think it's going to, even if the war miraculously ended today, I think we'd be seeing these sort of ripple and pass-through effects of the war on food prices for quite a while to come.
And of course, the impact on the energy prices, and the European automakers in particular, they're trying to figure out ways to use less fuel. And I think Volkswagen actually in its last earnings statement put out how much the war had been costing them. Less so for US automakers, but European vehicles come here to the US as well.
Well, so it seems like you're saying, Ricky and Michelle, that the war is having a very significant impact on food prices, maybe even more so than COVID. We started with that, but where we're ending up is there are some geopolitical issues that is having a pretty direct impact. One of the things that occurred during COVID, and we talked about this on our supply chain webinar, is that there were certain sectors that were winning, particularly in transportation and logistics. And you had a lot of the global shippers that were charging ridiculous prices. A container went from $2,500 to $25,000. I think there were also several of the container companies and shipping companies that had more profit in 2021 than they had in 30 years previously, all combined. And so I guess the question is here, Michelle and Ricky, are you seeing some companies that are using this, we've got inflation, we've got a war, we've got higher energy prices, to increase their profits as opposed to actually struggling with issues for their increased costs?
Well, in my segment, dealers have had record profits like they haven't seen before, but that's going to come to a halt. We're already seeing that dial back because they just can't last forever. The automakers were doing pretty well, but we're going to see that dial back because it is ultimately volume does make a difference. Suppliers, on the other hand, very hurt. They base their business on volume, and when the volume's down, we're seeing a lot of them file bankruptcy or merge, that kind of thing.
Wow.
Sorry.
Very helpful. Ricky, you were going to say something?
Yeah, and Michelle, I'm sorry if I started to interrupt you there. Yeah, there have absolutely been benefits in terms of revenues and profits, in some cases record profits for food companies. And it's been, but these sort of effects have not been evenly distributed sort of throughout the food supply chain. So COVID and really just the current market environment continues to be very, very challenging for specialty crop producers. If you're growing fruits, vegetables, tree nuts, very, very, very challenging time in terms of the cost of inputs, the challenge of achieving transportation in a timely manner and getting products moved from point A to point B. Food manufacturers, the big major companies have had a really, really great 2021 and 2022 so far. And then in food retailers, among the grocers, the brick and mortar stores that we all visit, it's really a question of, by and large, it's been a question of size, infrastructure, and capacity, because for the most part, smaller independent retailers there's, I don't know, 4,000 or 5,000 of them across the United States. They're really, really vital for food access and food security, especially in rural areas. They're a major driver of employment in rural areas. They're really struggling. For the most part, they're having a really, really hard time because their labor costs and their transportation costs are up so high, and they're dealing with record levels of food shortages. But the larger chains with the buying power, with the national or the regional market share, the ones who reliably are getting product from the wholesalers and from the vendors, yeah, they're doing pretty well. I mean, I'm not ready to comment and say that their increase in profitability is strictly due to just increasing prices to sort of ride ahead of that wave of inflation. I'm not arguing that's not going on, but it's worth pointing out that a lot of these retailers have really put a stronger emphasis on more perishable, value-added, higher margin items, and that's also been a factor that's been driving up profits in the grocery sector. But the short answer to your question is that going on? Certainly.
Interesting. So one of the topics that we wanted to cover, and I sort of mentioned at the end of the slide, the old school versus the new school, and how businesses were able to adapt. Would love to hear you expand a little bit more on that, Ricky and Michelle, in terms of your areas. Did you find that those comments that I shared accurate? And what other things are you seeing with respect to how businesses are going to be able to be successful?
Yeah, I was really happy to see that you had a bullet point in the new school that basically, I think you touched on artificial intelligence and big data and all that. And just as a general catch-all, the one thing I stress, and this is for companies of all sizes and all throughout the food supply chain, is data, data, data. I cannot stress that enough. In this current environment where we're dealing with all these supply chain challenges, food companies cannot afford to get that wrong. They can't afford to get their inventory management wrong. They can't afford to estimate demand or the input of the supply of their key inputs incorrectly. It's going to be the difference between success and failure in an industry that is dominated by low margins. So rather than sort of touching on all of them, I'll just sort of like kick off the answer to your question by saying, I think proper data analytics, keeping track of what has happened, staying organized, and analyzing it in order to make careful, clear, data-driven decisions for the future is likely going to be the difference between profitability and loss for a lot of food companies moving into the end of 2022 and into 2023, when we're still going to be in this challenging, high inflationary environment.
That's great. Michelle, any more comments on that in terms of what it is that you can see businesses to do in order to be successful in this new environment?
Yeah, I think what we've seen in the auto industry is, first, when everything shut down, auto dealers had to do what consumers wanted them to do for a long time. Let them do their shopping online, do most of the deal online, and have the vehicle picked up and dropped off. That is going to stay around and even grow further. They've wanted it for a long time, and now it's happening. The supply chain, I think, some companies took their eye off the ball, and we are going to see a different way of automakers getting much more involved with buying supplies, especially things like chips, and we're seeing it with minerals, with EVs, versus letting the suppliers do it, and then they don't have a view into the supply chain. I don't think we'll ever go back to the days of 3.5 million vehicles sitting around the country waiting to be bought. Right now we're at about 1.5 million, and maybe we'll go a little higher, but I don't think we're ever going to see that kind of inventory buildup that causes automakers to have to discount. So I think that's going to change drastically.
Those are some pretty significant and profound changes. Oh, sorry, Scott, do you have another comment on this?
Yeah, can I just chime in on the end there? I agree with both of those, and that's why we exist at Morning Consult. This is what we do. We provide the high frequency data that companies need to make these decisions. So just throwing that out there. That's our entire purpose. We survey at a higher speed and higher scale than anyone else.
That's great. Well, I do want to say we've got about 10, 15 minutes left or so. We have had audience questions that have come in throughout and want to continue to invite any audience members that do have questions to ask us. We've also got a lot of additional topics or some areas that we haven't yet answered. Scott, I guess as we talk about this new world and the era that we're going into, one of the words that comes up is stagflation, right? No growth and combined with inflation. How probable is that to occur?
In the near term, very probable. And in fact, to some extent, that is the soft landing that the Fed has in mind. Slow growth with inflation gradually coming down without having to crash the economy. So that is sort of my mode of forecast here for the next few quarters for sure.
You're expecting that to occur, and that's the goal. How hard should the government be working to fight the inflation that's occurring right now?
Certainly from the Fed's perspective, they're doing a lot. Like this, the increase that we've seen in interest rates is incredibly rapid. We haven't seen anything like that since the 1980s. And I think that's justified. Fed was a little bit behind the eight ball here with inflation. I picked up at basically last year around this time, started to pick up a little more than what people were expecting. That's when transitory was retired and it became something else. And so they've been catching up. Policy is now into a restrictive territory. So now it's a matter of waiting to see some of this impact on demand. Probably will be slowing the rate of interest rate increases here going forward, but certainly interest rates are still going up for a while.
We talked about the impact of the war in Ukraine that's occurring, and we talked about COVID. We didn't necessarily talk about the COVID stimulus that's occurring or the extensive spending by the government, right, and the deficit that occurs. Those were some of the things that were done to stimulate the economy, previously. But I guess will there need to be a slowdown in that, and will the war need to end also in order for inflation to stop?
I think the stimulus part has reached its conclusion, right? So I doubt there will be any more stimulus coming on unless we, hit another recession, something comes along. And even then, I think bringing down inflation is going to be the priority for the Fed. From the federal government's perspective, you never know. There's a lot of uncertainty right now. We still don't quite know who controls all the houses of Congress, though I think it's starting to shake out there. We've got 2 years of a bit of mixed government here that we're going to have to deal with. I think looking back in time, I want to make this point really clear. The stimulus that was put in early on during the COVID pandemic was entirely needed and absolutely essential in the recovery that we saw. Is there a point in time in which maybe the stimulus became a little bit too much and overheated the economy? I think the research is starting to suggest that, yeah, it might have been a little bit too much in the later stages. But those initial responses to COVID, when we shut everything down, like Michelle mentioned, we didn't really have a recession. This is a very unusual recession. By any metric, we would not really call this a recession except for the magnitude of the decline that we saw over a very short period of time. But incomes barely budged. We kept income support going here in a way that we've not seen before. So that was successful. Whether at some point that became a little too much, that's still up for debate.
Well, let's be clear here on, you say a recession, Scott, because there was the period of time that we were in COVID. I think that's what you were referring to, which wasn't a recession. And then we've got our, the economy right now. And I think this is one of the periods that there is some debate. Are we in a recession? Are we going into a recession? Certainly retailers are buying less. In the United States, I think the expected purchases from retailers are down about 30%. Inventories are too high, and that was what led to some of the the changes that we saw in the declines in the stock market. And so I guess I'm curious, are you thinking also that we're going to be going into a recession now, or are you referring to a recession previously?
My comments earlier were about the COVID recession itself, that barely qualifies as a recession by most traditional metrics, other than the magnitude. The current situation, National Bureau of Economic Research has not called this year a recession, and I don't think they ever will, despite the declines in GDP that we saw earlier in the year. It just doesn't meet that traditional definition because the labor market is just way too strong for it to be a recession. Going forward, though, that's a more open question. So we will be seeing the economy slowing. We're already seeing it slow. We have a lot of monetary policy restraint that's going to be absorbing. How far we go with that's a little bit unclear. I think the expectation a lot of people have is a soft landing is probably not going to be the most likely outcome. I will say I'm a little bit more optimistic by some of the recent data that we've seen that maybe a soft landing might be more possible than I thought it was 3 or 4 months ago. The CPI report last week in particular, and some of our own high frequency data suggests that maybe demand and supply are pulling into balance a little bit quicker than I expected. But I think most people will tell you a soft landing is not the most likely possibility.
You think that most people are expecting that it's going to go hard and swing the other way as well?
I think that most forecasters are expecting some decline in the economy in 2023. It's a matter of how much. Not completely sold on that, but I can see the reasoning behind it for sure, because we do have a lot of monetary policy restraint coming online. And when the economy slows, when you're in that sort of stagflationary environment, it doesn't take much in terms of a shock to push it into a recession. And I think, we have the war in Ukraine still out there. We have still these other uncertainties that could easily be that tipping point.
Our position would be that
government. Oh, sorry.
I was just going to say, our position is that the auto industry has been in a recession for the last few years. We're seeing recessionary levels of sales, but driven by supply. So what we tell people is we think if a recession happens, the auto industry will not fall off a cliff. It'll be more like falling off a curb.
And Michelle, you said earlier that dealers have had record profits. That's coming to an end here. Has that happened previously in recessionary environments where dealers have done very well and have had a windfall?
I don't remember a windfall like this one, where we've never seen a period of time where vehicles are selling way over list price, and that's what we're starting to see soften first. The big markups may be coming down, so there's still a lot of cushion there, and they're still doing well, but it may not be sky high.
Okay. And Ricky, are you seeing sort of unprecedented variables or very unique situations in this environment than what you've seen in the past?
Yes, absolutely. The last 2.5 years have been unlike anything I've ever seen, for sure. Obviously, COVID was incredibly strange because, as Scott was saying, technically a recession, not by a lot of standards. And if you look at food, of course, it was kind of the opposite, right? It was a massive explosion in demand for food like we've never seen before. And then, just sort of to sum up sort of some of the comments that I've been making, I mean, the situation that we're in right now, recession or not, is that the food supply chain, food prices are sort of, inflation is being sort of pushed up, right? Food prices are pushing in that direction at the same time by these sort of lingering issues with transportation and labor, which we've talked about, severe weather effects, which we haven't really touched on, but those continue to drive major volatility and supply shortages and all of that. And then, of course, the lingering volatility and occasional surges in energy prices, which affect food prices throughout the entire supply chain. So we have these forces. We don't really see them going away. It's the main reason why I think food price inflation will remain at least double the norm going into 2023 and throughout 2023. However, I do want to stress, and I don't know if this gets at your question directly, Martin, but COVID was an impact on the grocery sector, on the food at home sector, and it's the upstream, manufacturing and production that feed to it. It was a stress that we've never seen, or at least the last time we saw it was 100 years ago, and back then the food supply chain looked nothing like it does today. I do want to say that I spend a lot of time talking about how COVID identified these issues, these structural issues that we have with consolidation and rotation. That's all true, but it also revealed that we have a very, very resilient food supply chain. We do. We have, and it links together very, very effectively, and it is a marvel that, you know, we have the United States households on average, when COVID hit, March of 2020, we had reached this equilibrium. We were at maybe 48% in our food spending away from home. We were spending more food away from home. That flipped to, I don't know what, overnight, it flipped to 75-25 in the other direction, maybe even more, you know, when food service shut down. And we didn't run out of food. We didn't have widespread food shortages. We didn't have food prices double. We didn't have a significant increase in people going hungry. We didn't have riots. We didn't have civil unrest. So kudos to an industry that has showed itself to be resilient and is going to continue to feed the population without pricing Americans out of being able to buy food anytime soon, given the challenges that we're facing.
That's great. Michelle, Scott, Ricky, we are coming to the end of the webinar. I'd like to sort of finish here or summarize with your, you know, one or two observations, most significant observations about what we're going through, and then one or two recommendations for leaders now in this environment of businesses, what it is that they should do. Michelle, do you want to kick us off?
Sure. I mean, I hate the word because it's overused, but we're in unprecedented times. So I think keeping tight control on costs, keeping inventories that cost a lot in terms of interest rates are important, being really flexible and able to move quickly, and focus on the customer. We didn't talk about it, but the kind of customer that's coming into the auto dealership is not the customer of a time ago, and there needs to be an adjustment of who that is.
Great, very helpful. Ricky.
I know, Martin, that you and your team are familiar with the PPI because I saw the producer price index cited in your slides. If you look at the latest PPI numbers from the BLS for all of the industries that are directly responsible for getting food to our plate, cereal manufacturing, warehousing and storage, all of that, these things are almost all up still double digits over where they were a year ago. But if you go back 6 months ago, maybe they were 25-30% up where they were a year ago. So we're still dealing with major inflationary pressures. They have abated somewhat, and I fully agree with USDA forecast that food price inflation will be above normal, but significantly less than where we ended up in 2022. I just want to stress that I gave my kind of short-term prescription for more data and analytics and use. Moving forward, I think the food industry continues to make and needs to make significant investments in automation, renewable energies, the forces that will help to insulate them from these ongoing labor shortages and these volatile energy prices that are plaguing the system.
And we didn't spend much time talking about automation at all, but that might deserve a webinar on its own. Scott?
Yeah, I want to pick up on that last point. I'll start with my recommendation. Productivity. It's all about productivity from here on out. I want to see companies. You had it on one of your new school slides. Incentivize productivity. I think that's what we need to work our way through some of these supply chain issues and really get ourselves into a better position going forward after COVID, life after COVID. In terms of insights, I would say the CPI report that came out last week, the market really responded quite strongly to that. I think you saw some policymakers push back on that. Maybe the markets responded a little bit too much. I would say if you dig deeper into that, and we've done that here at Morning Consult, and we've linked it to our own data. This is what we put out this morning in a memo. There are some reasons to be very optimistic about what we saw in October. We saw some broad-based supply and demand side improvements on the inflation front. And so, while I think that inflation is not going to be that low in November, and we're not going to get that big low number like we got in October, I do feel like the trend is going down, particularly core CPI inflation. I think that might have peaked and we might be seeing lower numbers. So we're still talking about things in the 4 to 5% range at an annual rate. If you take the latest data, that's too high. The Fed wants it down to the 2% range. So we've got a ways to go. There's still a long ways to go. But I do feel like for the first time that we've made progress. This wasn't just energy prices coming down like it was over the summer. This was something a little bit broader. So I'm more
Great.
hopeful.
Well, thank you, Scott, and that's a great note to end on. Michelle, Scott, Ricky, all of our audience members, Court Magazine, we want to thank you for your participation. Very engaging and very thoughtful commentary. We talked about COVID, we talked about the war in Ukraine, we talked about the impact on the federal funds rate, we talked about consumers, businesses, and what it is that they should be looking to do in order to respond to inflation. And then we talked about how long it's going to last and what are some of the things that Fed policy will do to help with that. So very helpful conversation again. Ricky, Scott, Michelle, thank you so much for your participation. Thanks to all of our audience members. Bye-bye.